Hello, today is February 9th, 2023, and it's time for a new stock pick video. As always, I'll review the performance of the picks that I made this time last year, then talk a little bit about the economic environment and the market conditions, and then proceed with some new stock picks and the rationales behind them. So this time last year, I picked Manulife, the insurance company. The stock was down 15.3% in US dollars, including dividends. Imperial Oil, the energy company, that stock was up 22.1%, including dividends. And Clearfield, an industrial company, that was up 1.6% for an average of 2.8%, which compares very nicely against the performance of the MSCI World Index, as represented by the URTH ETF, which was down 8.8% in US dollars, including dividends. This year, everybody should know by now, because it's been talked about for months on end, we're likely going to have a recession. It's a well-predicted recession, but it's still likely to happen. Multiple reasons, main one being interest rates a lot higher than they were this time last year. Mortgage rates in the 6% compared to, let's say, 2% area this time last year. So home loans, mortgages, car loans, everything is more expensive, yet incomes are not up nearly as much as they would have to be to keep the same level of demand. So demand for loans should be down given the higher rates. In addition, we have what's called an inverted yield curve, where the 3-month rate in the US is around 4.7%, and the 10-year rate for the government of the US to borrow is at 3.6%. So the short-term rate is higher than the longer-term rate, which is very unusual. But that causes banks to want to lend less, because they tend to borrow overnight in the short term and lend out in fixed terms, let's say 5 years or more. So that reduces the money supply, and then it reduces aggregate demand for all goods and services. So that, as well telegraphed as this recession is, it doesn't look like we'll be able to avoid it, but maybe it won't be as bad. So we'll see. Under that scenario, usually as investors, we like to overweight the more stable businesses that are not affected by economic slowdowns as much. Things like utilities, healthcare companies, consumer staples, necessities and things like that, grocery stores. Having said that, because this has been such a well-telegraphed recession, the market, I believe, has already priced those stocks appropriately. So the opportunity is not there anymore, and I believe there are better opportunities in more economically sensitive companies that will not do as well during a recession, but the stocks are cheap enough, the prices are low enough for us to be investing there instead. So we'll see. But the theme for the 3 picks that I have today is similar. They are economically sensitive companies, but the stocks are, in my estimation, about 30 to 35% off of what they should be. So there is a good 50% upside or so potential if they go to their fair value. And it may not happen in the first year due to the fact that if revenue and earnings slow down, the stocks will not move up. But in a 2 to 5 year hold, as markets reprice themselves, these stocks should do well. First stock is Rio Tinto, first stock pick. One of the largest global diversified miners. Again, these sort of businesses tend to be very tied to the economy, but the stock price is very reasonable. And in addition to that, we have more of a long-term increase in demand for minerals from the electrification of vehicles primarily. In production of electric cars, a lot more minerals are required than a typical gasoline or diesel cars for batteries and for all the electric components, such as we need copper, nickel, lithium, etc. A lot of minerals, and so the sector is likely to do well. And this is one of the largest one, so it's an easier way to participate in the market, holding a big, diversified one. Second one is a financial company, in fact, a wealth management company called Silvercrest Asset Management. They are in a similar business to ours in the wealth management and providing financial advisory services to ultra-high net worth individuals, institutional investors, traditional strategies, equities, fixed income, cash, hedge funds, private equity, real estate, commodities, the whole gamut. Again, this sort of business generally does well when the markets do well. So if we have a bad year in the markets, this sort of stock is likely to not do well. But because it's priced well, it has something like a 30%, in my estimation, margin of safety. So we have a lot of downside protection, or looking at it differently, a upside potential to when it reaches its fair value. So that's stock pick number 2. And the third one that I had for today is Valero Energy, symbol VLO. This is one of the largest refiners in the world, and as much as moving towards electric vehicles every day, more and more electric vehicles are being bought, we still need gasoline and diesel and ethanol and all these nice things that a company like Valero refines. And the stock appears to be very cheap. And I say appears because with an economic slowdown, it may get cheaper if its fortunes turn around for the worse. But we hopefully will have a soft landing, as they say, an economic slowdown, but not a massive economic slowdown, and the stock will do well, particularly because it's undervalued. As always, if you'd like a second opinion on whether these stocks fit in your already well-diversified portfolio, or if you have any other questions, please don't hesitate to give us a call. Great. Thank you. Have a great day.